Yeah, yeah. It's coming back to me from when we talked a couple of years ago. Um, so the timeline, the value is we wouldn't have our clients or us wouldn't have a timeline to be worried
Correct.
about.
Correct.
They have to set the trust up with you ahead of time, or can it happen? Can they make the transaction and then still set up a trust?
Yeah, great question. So let's talk about the 1031 options here, right? So we also have what's called the best 1031 exit plan. And by the way, we're not saying don't do a 1031. We're just saying use the 1031 through us and our team to be able to give you a backup plan in case it fails. We call it like the golden parachute, right? So you can go shopping for your 1031, go looking for your deals. And about day 30, day 40 or so, you're like, I'm not really finding the properties to identify. I would like to just move off of the 1031, train that's moving forward, and I want to exit into this trust strategy. It can be all or in part. So we had a client, a Texas sale, $6 million ranch sale. He did a partial 1031 into an Oklahoma City property, partial 1031 into a South Carolina property, and then the rest of it went into the trust. Welcome to the Builders to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more or all of it away to help MVPs. My name is Brett Swartz, and I'm joined today by Glenn Hanson, who's got an amazing, incredible background. He's the CEO and founder of Colony Hills Capital LLC in the greater Boston area, and he's a seasoned private investor, entrepreneur, and boasts 4 decades of adept leadership and steering thriving ventures. And he's got an amazing background. And today we're going to be talking about basically why operators should stop defaulting to 1031 exchanges and start offering a more flexible exit path with the deferred sales trust. Quick background on myself, our company Capital Gains Tax Solutions offers deferred sales trust for clients that are exiting Bitcoin businesses, real estate, and have large, massive capital gains taxes. But Glenn, one of the biggest challenges is that people get stuck in these 1031s, or they get in these positions of trying to put deals together, but the tax dog sometimes can sink the ship, right? And it can hurt opportunities and deals. Maybe we can start with a little bit of your background and your expertise, and then kind of dive into that deal story that we were just chatting about.
Sure. Yeah. Actually, talk about my background. You went back 4 decades. I was reflecting on that just the other day, and I got my pilot's license back then, and it really helped steer my businesses to a more successful conclusion. And if you ever think about it, manufacturing scrap rate is allowed to be, if 1% or greater is your scrap rate, it's okay, right? And if you think about in the United States, there's 3,600 planes in the air at any one time. If we had a 1% scrap rate, we'd be losing 30 planes a day. And why is that? How is it possible that the airlines can do and function at that type of quality control, and we in business sometimes miss the mark? And I bring that up because you started with 40 years ago, and that's driven me to always look for solutions to keep us from crashing, right? So when I think about the 1031 exchange today, I have clients that come to me with 1031 money, and we can't help them because we can't identify the deals fast enough. And so I wanted to reach out to you guys, Brett. Having met you a couple of years ago, followed your success, and it's neat to get caught up a bit, but I wanted to just try to understand how I can utilize 1031 to help my clients. And of course, that benefits us because we become a resource for them. And when we first met, and you talked about 1031, or you talked about the tax gain solution that you have, it wasn't something on my radar, and I'm not sure that you had fully baked the way to manage it. So I'd really like to dig in under the hood and see what have you figured out so that we can transfer those people over to you, and you can satisfy them, and then hopefully they'll invest more with us.
Absolutely. And I think it's good to start with like the problem, right? The problem is obviously a big tax bill. The other problem with the 1031 is a short time frame. And the next problem is it doesn't give you an opportunity to diversify or to dollar cost average or to really have the liquidity, right? And we're seeing some of these things come into picture right here. I mean, think about why some of the deals, especially in multifamily mobile home park, haven't worked out. Well, people bought 2021, 2022, and they likely or could have overpaid at that point. A lot of it because of the 1031 driving values, right? At that point, too, cost seg and bonus depreciation, another tax tool that was increasing the valuations of properties because people could bonus depreciate. That's also coming back this year as well. So understanding that tax flow and tax deferral incentives often drives value, and it can be inflated value. Now, no one knew what the interest rates would do, at least to the extent that they did it, doubling. That's kind of hard to predict. But still, just think about that. If we had a crystal ball, we could go back to 21, we could probably say, this is pretty high. 22, this is probably pretty high, or this might be the peak, at least close to it. We were in this bull run of 10, 12, 13 years of the market, right? And then there's typically corrections, I think, around year 10, 8, 9, 10, maybe anyway. So you look at this and you say, okay, what could we have done? In a perfect world, you would have sold everything at the peak. You would have paid off all of your debt, right? You would have sat in the money market account, or you would have sat in some conservative stuff, and you would have started buying, let's call it right now or last year, some good opportunities. In other words, that timing aspect between 2022, let's say, was the peak, to now we're at 2026. It's definitely changed drastically. In fact, we've seen, a lot of some colleagues, people we know, even some of our deals haven't turned out so well. And so the key here is I want you to focus on is that tax flow, or capital gains tax flow is really what I'm saying here, right? That is what's driving typically why people are buying in those same marketplaces, right? And so the problem is timing. You really want to solve for that. The second problem with this is debt. In a 1031, you have to replace equal or greater debt. So it's equal or greater value, but people forget that means if you have debt on the property, you've got to replace the debt. Well, what happens when your debt interest rate goes from 3.5 to 6.5, 7? Well, you have a big problem, right? If you've over leveraged. And so people who do these 1031s are not only, deferring tax, which is a good thing, but they're having to overpay oftentimes, or stuff that they wouldn't normally buy because they think the market is probably pretty high at that point. But then the killer here is the debt piece, and the debt has been sinking these ships. And so we want to walk you through step by step how to solve for that right now by eliminating the need for the 1031 exchange. But really what I'm saying is eliminating the need to have to go into more debt or equal or greater debt, eliminating the need to have to stay in real estate or buy in that same marketplace. And it's using something called from the IRS tax code 453 installment sale reporting, okay? We're going to couple it with the trust. And when you do this, this is where the magic happens, because you're no longer in the 1031 world, okay? And that's a beautiful thing, right? I like the analogy of Blockbuster versus Netflix. Glenn, you probably remember the days when you had to drive, in the snow in Massachusetts, park in the parking lot, trudge through the snow in freezing cold weather, go into that Blockbuster just to find out that behind that cardboard box, you thought there was a movie there or a DVD, but it wasn't, right? You're like, oh, I wish that was the movie, Even if you got the movie, you have to return it in 3 days. You have to have the late fees. You have to rewind it. There's some nostalgia in that. I think there's still one Blockbuster up in Bend, Oregon, I heard. But the reality is something changed. It was the Netflix, right? So Netflix, there's no more return policy. It's an ongoing, monthly cost, right? But no rewind, no late fees, no driving. That's what I'm about to tell you, because what we have here with an installment sale with the trust, known as a deferred sales trust, you're able to sell and defer the tax and have none of the time restraints, none of the debt replacement requirements. There's some rules that we have to follow a little bit here in case we have debt over basis. But what this does is it gives you, the operator, Glenn, or anyone who's listening to this, the ability to now go into investments not only at any time, but also any investments of any kind. So it can be into passive real estate deals. It can be in the stock market. It can be sitting in the money market account. It can be in real estate debt deals. It can go back into your own deals. In other words, you're not constrained by time. You're not constrained by debt replacement. And you're not constrained by asset type. And you ask, why is that? Well, why can we do that? Because we're not using a 1031 exchange anymore. We're eliminating the need for the 1031 exchange. So the first thing to understand is our strategy and our process eliminates the need for the 1031 exchange forever, number one. Number two, it also gives you the ability to save a failed 1031 exchange. We'll talk about that here in a second, but I want to make sure the first one makes sense, Glenn. Any comments on timing, debt replacement, and flexibility for investing so far?
No. I comprehend what you're saying. How do you apply it?
Okay, let's do an actual real case study, right? That'll kind of bring this to life. We had a deal I'll use this one in Sacramento. Warren and Catherine, they're selling a multifamily property for $2.5 million. Their basis was pretty low. Had they sold and not done any planning, they would have paid about $1 million of tax. So their biggest constraint was time. I mean, they had made their kind of multiple millions of wealth, in their mid 50s, and they're really wanting to free up their time to spend with their kids, travel more, and basically move to more of a retirement passive stage. So what's beautiful about the trust is it allowed them to not have to do a 1031, trade their 15 unit property for 30 units, right? In other words, they had 15 problems, they didn't need 30 problems, right? And so they were able to do that, sell, pay off any debt that they had, diversify their wealth. And so they sell it to the trust is step one, and the trust sells it to the buyer. Step two, it's actually really simple. This trust comes inside of the escrow through a contract, and it's basically an assignment of sale. And so they sell it to the trust on an installment sale method, known as again IRC 453, and they report it as an installment sale. And then the trust sells it to the buyer, and the trust has no gain, Glenn, because it sold it for the same price that it bought it for. And the trust is an unrelated party to Warren and Catherine, and it owes them money and gives them a promissory note. In this scenario, I think it ended up being around maybe 2.3 million or so, whatever, net of closing costs or such, that went into this trust that owes them this promissory note, owes them this money via a promissory note. And now the funds are sitting at Charles Schwab, and then it can be invested back into deals like with Glenn or back into their own deals, and they can diversify. And that's really the key here. I mean, think about it. If people are over-concentrated in a single asset in Boston, Massachusetts, or in New Hampshire with a business, or a large primary home in the Hamptons, right? And like all of their wealth is accumulated in this multiple $1 million, right? And it's not diversified, it's not liquid, it's maybe not producing the kind of cash flow they want. The ability to now convert that to become a creditor, right? And that's really what they're becoming. They're becoming a bank. So Warren and Catherine are a bank, and now this trust is going to pay them back. And so they'll just pay tax as they receive payments. So it's really that simple. Now there's a third-party trustee. That's our company. That's how we work. And we work with the family, work with if they have a financial advisor and their CPA to make sure everything is all set up well, and they understand it and they're comfortable. And then they can invest in groups like you, Glenn, because a lot of these real estate owners, they want to be in these passive, 400 plus unit apartment complexes that you put together, right? They want to be in there, but they feel trapped because they cannot 1031 into it, but they can, through our strategy, defer tax and invest into it passively. And that's really the power of what we do. Yeah.
It's coming back to me from when we talked a couple of years ago. So the timeline, the value is we wouldn't have our clients or us wouldn't have a timeline to be worried
Correct.
about.
Correct.
They have to set the trust up with you ahead of time, or can it happen? Can they make the transaction and then still set up a trust?
Yeah, great question. So let's talk about the 1031 options here, right? So we also have what's called the best 1031 exit plan. And by the way, we're not saying don't do a 1031. We're just saying use the 1031 through us and our team to be able to give you a backup plan in case it fails. We call it like the golden parachute, right? So you can go shopping for your 1031, go looking for your deals. And about day 30, day 40 or so, you're like, I'm not really finding the properties to identify. I would like to just move off of the 1031, train that's moving forward, and I'm going to exit into this trust strategy. It can be all or in part. So we had a client, a Texas sale, $6 million ranch sale. He did a partial 1031 into an Oklahoma City property, partial 1031 into a South Carolina property. And then the rest of it went into the trust. And so sometimes it's a mixture of a couple different strategies. So our company provides all of the strategies. But our advantage, especially for the 1031 buyer, is that you no longer have to feel forced to buy a particular size deal in a particular time. Now, you might be in a $100 million exchange and find a perfect $25 million deal. Well, great, buy that with the 25, the other 75 can go into the trust. That's a great thing, right? Rather than being like, I love that $25 million deal. I kind of like this $110 million deal. Man, I'll buy the 110 just because it fits the exchange. No. Don't let the tax tail wag the investment dog, right? Buy the 25 and put the remainder into our trust, right? Because you could always turn around and invest into that deal later on when the timing's right, which again, back to the 2021, 2022, probably the peak, knowing what you know now, you would have sold everything. You would have put it into the trust. You would have sat in the money market account or some conservative real estate debt funds that we know we work with that are great places to kind of park, 30, 60-day liquid kind of opportunity when you're in there making double-digit returns. And then when the market finally shifts, and you can turn around and invest into those deals. Here's the key, tax deferred. It doesn't have to be taxable at that point. You can actually partner with the trust through an LLC, and then you can go buy these deals. You can run the deals yourself. It can go into your own fund. It can be passive into other people's funds. This is why it's like the Netflix, right? Because you're getting everything that Blockbuster offered, plus you get all this tons of flexibility. This is typically the point where people's heads explode and they go, Glenn and Brett, like, I haven't heard of this. Like, why? Where has this been? And it seems too good to be true, which we can touch the three biggest objections here in a second. But back to the 1031 part of it, you work with us, and then we give you both options. Now, let's say you're not 1031 eligible. You say, Brett, I'm selling a business, I'm selling Bitcoin or stock. Can I still use your strategy? Yes. And all three of those are not 1031 eligible. We also work for primary homes. Those are not, none of those are 1031 eligible. So in that scenario, Glenn, we need to set it up prior to the close of escrow. So you'd be under contract, ideally you even get this in place before even contract is even more ideal. But here's the key. We work on we call it a pressure-free, promise. Like, we'll never talk you into anything. And if for some reason your deal doesn't work out, you don't owe us anything. If your deal doesn't close or you don't want to use it, we don't owe us anything. But our trust gets put in as an option into the contract, right? And as the deal goes along, then it can be executed at the end of the sale. And at close of escrow, the funds can go to the trust.
Wow, you've got that worked out pretty good.
Yeah.
So, Brett, you're talking about the trust, and my memory's coming back up. How does it function when it's in the trust? How can I control that money, or do you control it? And what percentages can we take out and not be burdened?
Great question. So there's three major objections, and we'll touch on the one that number one that seems to be the toughest one for people, is the control, right? So if you've ever done a 1031 exchange, you've given up control for a period of time. That's part of the rules. You've got to send it to a third-party qualified intermediary, and you got to follow the rules. 45 days to 180, depending on your identification and those things. So think of us kind of like a long-term 1031 exchange company, kind of like, okay? Or kind of like an IRA company or 401k company, where you're sending it to a third-party group, and there's certain parameters and compliance and controls in place, but you do have to give up some control. And this is what enables the tax deferral and the tax code. And so what does that mean practically? Well, first of all, the funds are never invested into anything that you don't approve. But you are the creditor, right? So you're like the Bank of Glenn. Let's say you did a $10 million deal exit out of in Massachusetts, right? And you had a zero basis on the property, and you had zero debt to keep it simple, and you sold it for $10 million. You would have paid, I don't know, $3.5 million of tax, but instead the full $10 million's in the trust. We write a note at, like, let's say 9%, and so it's $10 million earning, hopefully earning 9%, but you have to approve of the investment. So funds hit the Schwab account. Now, an advisor says, you know what, Glenn, I'd like you to go into these investments. Here's what I think. What do you think? And you either say yes or no to that. Trustee says either yes or no to that. Collectively, we say yes together. Technically, it's the trustee who is on the with the trust on the account, but you're the note holder, right? And so we have a policy where we want to invest, and there's no upside for us to say yes to something that you don't say yes to, right? So we have a policy, that's how we work. But giving up some of that control allows for the tax deferral. right? Because think about it, the government gave up their 3.5 million of control. So you can have unilateral control of, let's say, 6.5 million, or you could have, you could call it bilateral control or just less control than unilateral. And that allows for this tax deferral, right? Now, the second piece of this is really important for the entrepreneur like yourself, Glenn, is you can partner with the trust. And so this is the piece where you're like, well, what are you really giving up? If you could turn around, and we like to say about 80% is a general rule of the 10 million that you could turn around and just go back into your own deals. It's a good rule of thumb where you are the managing member of a new LLC and you're running that, and the trust is a silent joint venture partner. Now, this is beautiful for the entrepreneur because isn't that what you want? You want to be able to do your own deals and call your shots and hire the property manager and do all the different things, right? Yeah. And so the trust can silently partner with you on a deal. As long as it's a business or investment, it's not your primary home, it's tax deferred. That's the game changer, honestly, right? Because now you're right. Now the other 20% is you still to approve, trustee approved, but that's good to keep some diversification, some liquidity. So that's a general rule of thumb. Every client's a little different based upon their risk tolerance, based upon their income needs, right? And so we might more recommend like, hey, only take 50%, because this is, and be more diversified. It's dynamic. This is why we want to work with financial advisors and kind of work all through these things. But that's kind of the controls. The other thing I'd say is there's lots of transparency because you want to make sure you can trust the trustee in the process. We have a third-party tax preparer and they do the full bookkeeping that you give access to all of that. There's a third-party tax attorney that does all the legal work. There is third-party places like Schwab that are housing all of the capital. And all of their statements and all of the logins you can have there. In other words, it's very transparent and it's very clear and clean when it comes to understanding the numbers and where everything's at.
Yeah, wow, you did work this out. So those were some of my early concerns. At this point, how much have you done? Like, how many deals, or can you say in dollars?
Yeah, we're closing in on about $1 billion of closed transactions through commercial real estate transactions, 1031 exchanges. We've been parts of Delaware Statutory Trust and the Deferred Sales Trust. And this is collectively like brokering, investing, and helping people exit over all the years. So it's been a journey. I started at Marcus and Millichap in 2006 before the crash, helping people buy and sell multifamily properties. Before that, I helped my parents build single family homes, mostly in the Bay Area, own rentals. So real estate's been in my blood my whole life. And then I just had the fortunate opportunity to meet a really brilliant tax attorney, CPA, who's basically taught me everything we've been talking about here in the last 30 minutes or so about how to do this. And then you just start to do it and you actually learn it, right? So and you become proficient in what I'm talking about here. And that's really the key here. Like, you hire the who, don't be the how, right? So you hire the CPA to report your taxes. You hire us to help you with your capital gains tax exit planning. You hire us to help you through your 1031 exchanges. And then you will learn as you ride this bike with us how to do this. But it does take riding the bike. Like the first time you did the 1031, Glenn, you didn't know how to do it. You hire the 1031 company, they help walk you through it. And then when you've done a couple of them, it starts to become easier. The first time you put your syndication together or your fund together. So that's really key. We're the guide to help you every step of the way, but the key outcomes are massive. By the way, I want to touch on one other one that we hadn't actually prefaced, and it's one that gets missed, and it's the death tax and the estate tax, Glenn, right? Just teeing that up for everybody. This is the one that's, I think, the most missed estate planning tax that people just don't prepare or aren't really prepared for. So, Glenn, as you probably know, the stepped up basis does not solve for the death tax. The stepped up basis only solves for capital gains tax. And so if Glenn is worth 130 million, let's say hypothetically, and he's married, and let's just say 30 million of that is exempt. That's the exemption amounts. Let's say all 130 million of those apartment complexes are inside of his taxable estate. Well, a lot of people would think, well, Glenn passes away, his wife passes away, the basis gets stepped up. Correct, on the 130 million. However, the death tax is something outside of that. Estate tax, death tax. That's 40% of anything above 30 million. So if we take 130 million minus 30 million, Glenn, that gives us $100 million inside of your taxable estate. Times by 40%, that's $40 million.
Who's going to pay that?
The great question. And so when the kids get it, they're either fire selling the property, trying to refinance the property. A lot of people are maybe trying to buy a bunch of life insurance that is very expensive, or they're giving it all away to charity before they die. Now,
So I missed something though, when
Yeah.
you start talking about this, how does your program prevent that? I think that's where you were going, and if you mentioned it, I didn't pick it up.
Yeah, so now let's talk about how to solve for that, okay? So again, quickly, people typically solve it for this way. So they try to gift it away to their kids, but they run out of kids and they run out of time because you can only gift so much per year. They try to buy a bunch of life insurance, but that's really expensive, and that only puts a Band-Aid on the 40 million. They give it away to charity, which we love charity, but not everyone's 100% charitable, okay? So here's where we come in. We don't have to, all those three things, we eliminate the need for charity, life insurance, or gifting. And we ask you, and you would need to, before you die, sell that $130 million property. Find a buyer for $130 million, but we're going to set up a trust. This is our 2.0 version. It's an irrevocable trust that's set up right in between seller and buyer. And upon the sale, the trust is full, the asset is first sold to the trust sells it to the buyer. The trust receives this $130 million, but it's into an irrevocable trust where your children can be the beneficiaries. Meaning it's now forever outside your taxable estate. That's it. We converted it from inside your taxable estate to outside.
Is it forever?
Forever. I mean, as long as you don't dissolve the trust while you're still alive, and the trust is not dissolved, as long as it's, you just, you keep it in the trust, and it's invested into whatever you want. You can still invest into all the things we talked about before. That doesn't change. Same price. It's a different type of payout based upon your life expectancy, Glenn, and if you're married, your spouse's life expectancy. You will pay cap gains tax and ordinary income tax over your lifetime. So a little different than the other version as well. But upon your passing, it passes estate tax free. So we just eliminated $40 million of that estate tax. That alone is to compel people to sell today, right? And typically the capital gains tax is also eliminated as well, because you would have been paying that over your lifetime, right? So that is one of the downsides of it. You will take payments during your lifetime. You will pay some cap gains tax. But let's just say that 130 million grows to 500 million over 20 years, Glenn, hypothetically, right? Now you take 500 million basically minus your 30 million exemption. Okay, just doing some math here. That's 470 times by 40%. That's $188 million elimination. So it's exponentially working in your favor because you're growing it outside your taxable estate. This is what we can do. Real quick on the background too. There's been thousands of transactions with these trusts, close to 30-year track record. Now I think over 30 no change audits, just about.
That's pretty impressive.
Yeah, I mean, I think that's important, right? There's lifetime audit defense provided by the tax attorneys. So batting 1,000 so far. Now let me finish the other two objections that I promised I would touch on. I touched on the control one was the biggest objection. The other objection was the legal one. Like, people go and they hear this and they go, but Glenn and Brett, like, I work with some of the top CPA firms, and I work with top tax attorneys, and I work with top commercial real estate brokers and financial advisors. How come they haven't heard of this? Why don't they know about it? Or it seems too good to be true. I would first say, number one, hey, we're happy to talk with them. Like, jump on a call with us. They sign NDAs. We'll walk them through, the details, how it works, our track record, all of the things. We've worked with national law firms. We work with financial advisors. We work with CPA firms. I mean, we have all of that, but just because you don't know us or how to do it doesn't mean it doesn't work, right? So just come sit down, have an open mind. We'll work through it. Number two, this is one of the best stories I have on this. It's a gentleman named David Young, and David Young worked with a gentleman named Bill Gross, and they built a company called PIMCO. You probably heard of them, Glenn?
Yeah.
And them, about 5 guys, they helped to build this thing from 80 billion to 1.2 trillion. This is like 20 years ago. Long story short, they all retired. They got a big payday from PIMCO. Well, David and 5 of the guys, they get the band back together, and they form a company called Anfield Capital. And they look at this about 6-7 years ago. And like most of us hearing it for the first time, you're like, too good to be true. How do I know? Well, we said, hey, take a closer look, dive in with us, right? And they, oh, okay, we will. And they had their legal team sign NDAs, and they did about a 2-year due diligence. They didn't just, that wasn't 2 weeks or 2 days. They really dug into this thing, right? Over 2 years, they met and detailed it out how it all worked. Well, long story short, after all of that, they said, you know what, Brett, and you know what, Mr. Tax Attorney, we're all in. We're in, and we'll manage any capital for anyone who wants to use this. We'll be part of the team. And so I always say, if it's good enough for David Young and his legal team after 2 years of due diligence, is it good enough for me, Glenn, or anyone else who's listening to this? I mean, he's one of the best in the world at what he does, right? 30-year track record, one of the biggest companies ever. And now he's not representing it as a tax attorney or a CPA. So definitely bring in your group to vet. We want to get their as much as we can their blessing, but just realize that just because your CPA or tax attorney doesn't know about it, either A, you maybe need to get a different tax attorney, a different CPA who does, or B, have him come in and let us educate him and make sure that you get comfortable with it. But realize that the tax attorney on this side and CPA is like the brain surgeon who's going to represent you in the audit. Your family practitioner or your guy who's a specialist in just reporting and some cost seg and some 1031s, like, that is different than what we have, and that's okay. Glenn, you wouldn't expect to go to a hospital or your doctor, your primary care physician, if you need knee surgery or you need your eyes looked at. You're going to get specialists for each area. That's understood, right? In the health world, sometimes it gets missed in this kind of in the CPA tax world, and that's what we want to encourage people to keep an open mind and show up and talk with us, and we'll walk you through it.
Yeah. Exciting. I started out the conversation talking about the airline industry and their success, and the fact they have a lower scrap rate than the rest of the world in terms of running a business or manufacturing. And I think about what you're telling me here now is kind of like human factors in the cockpit. We've got to pay attention to what's going on and not just turn it away and really listen, understand what you at Capital Gain Solutions is talking about.
Yep.
I'm kicking myself because you and I had this conversation two years ago. Mm-hmm. You explained how it works, and I never took advantage of it, and shame on me.
Well, we're here now, and people that are listening, I just want to kind of give you a quick little summary, and then we'll kind of wrap it up here. Like, the deferred sales trust is not just about delaying taxes or deferring taxes. It's about creating a wider set of choices at the point of sale, such as that you can go in and invest with groups like Glenn Hanson and Colony Hills Capital, such as that you can diversify your wealth and eliminate estate tax, gain liquidity, get out of debt. So instead of forcing yourself or anyone you're working with to rush from one property to another via 1031 exchange, the deferred sales trust can allow you to sell, defer tax, create liquidity, and redeploy capital over time into opportunities that make sense for you when they make sense. And that's why it's like the Netflix versus the Blockbuster. And so I want you to take action by reaching out to myself or my team members by going to capitalgainstaxsolutions.com. Whether you're a financial advisor, CPA, real estate broker, M&A advisor, or a client yourself that you're looking at it, go to capitalgainstaxsolutions.com to get started. And Glenn, if people want to check out what you're doing and your investments, what's the best place for them to find you?
Yeah, colonyhillscapital.com.
Perfect.
Yeah.
Awesome. Thanks everyone for listening, and we'll talk to you again real soon. Bye now.